Walgreens Boots Alliance. This company, a dividend stock that investors love and have enjoyed for so many years, has tanked. It has plummeted. I am talking about your local neighborhood drugstore, Walgreens, local neighborhood pharmacy, convenience store. This stock, this company has disappointed Wall Street and has plummeted 13% in a single day. And in fact, it's already been trending down. And so after the plummet at $54 and change per share, this stock is trading at a 7-year low. You have to go back 7 years to September of 2013 to find prices in Walgreens stock that are this low. And so I want to cover Walgreens today. I already did a video recently about CVS. Really dislike CVS. Anyways, I will link to that video in the description below. It's just not for me, although I wish everyone in CVS the best of luck. But Walgreens, quite frankly, it is a stock I like. It's a stock that I like. I don't know if I'm going to buy it or not. We'll talk about that at the end of the video today. Most likely not, because I already have 40 stocks, but I like it, and it's one of those stocks that's kind of on the fence for me, and I'll share why today. Anyways, dividend yield. This stock yields 44 cents per quarter. If you multiply that by 4, you get $1.76. $1.76 divided by the current share price gives us a 3.25% yield. Not a bad dividend yield for Walgreens, because historically, we'll get to this later, it has had a lower payout ratio, which is nice, quick dividend growth rate. And so this is a dividend growth company, or at least it used to be. We'll see going forward what happens after the recent issues they've been facing. But historically, the dividend yield has been lower with a higher growth rate. And so seeing a starting yield of 3.25%, that is really good for Walgreens. And so the dividend has grown from 31.5 cents per quarter 5 years ago to 44 cents a quarter. Now, that is a compound annual dividend growth rate of 7%. And so I've done a lot of videos on my channel, and back in the olden days, I did some videos just generically, like how would I invest $1,000? How would I invest $5,000, $10,000? I'll link to them in the description below. And one of the things I always mention is I target companies that raise their dividend around 7% per year on average, and this is one of those companies. And I kind of like that it's at 7% because that's a really consistent, stable, good clip. It doesn't have to be higher than that. As long as you compound that in perpetuity, if they can keep it up, the yield on cost will be out of this world. And so, especially if the payout ratio really low like they have. So anyways, they announced Q2 earnings, and basically the earnings per share adjusted came in at $1.64 per share versus analyst expectations of $1.72. On this news, this stock fell literally 13% in a single day. I don't think I've ever seen that before for Walgreens. And so that was just, I don't think any investors were expecting this. And not only that, the management team at Walgreens anticipates, they announced to investors, hey, our earnings per share for 2019, it's actually going to be very consistent with 2018. It's going to be about the same. It's going to be flat. And so all of a sudden, all this phenomenal growth that they've seen in the past, we'll talk about that in a minute, is gone, at least for 2019. And this totally spooked investors. And they are seeing what they cited, and what analysts are citing, is pressures. And they're facing pressures primarily on the pharmacy space. The pharmacy space, just like for CVS, that's where this company makes the lion's share of its profits. The convenience store space, it's been kind of lackluster results for a while. I think it's generally a business that's been kind of steady, if not declining. But the pharmacy space, that's been their cash cow. And what is happening is there are pricing pressures on drugs. And so one of the things that I learned when researching this company that I didn't know is these drug prices, they're not fixed. You can go to different pharmacies and receive different prices. And so these companies like Walgreens are facing pressures on the amount of money that they earn for fulfilling these prescriptions that customers are coming in to fulfill. And it's being squeezed all around. It's being squeezed because consumers are moving to generics, because there's pricing wars, and there's the Amazon effect, quite frankly. Amazon is getting into the pharmacy space. They're not in it full-fledged yet, but they're getting into it, and customers are becoming more savvy, more price sensitive. They're starting to realize, like I just realized, hey, you don't have to go to one pharmacy. You can go to a different one and get a lower price. And at the end of the day, we are all consumers who want to save money. And so they're facing challenges there with the pharmacy business. Now, I'll tell you, I'm going to get into a lot of pros and cons later with Walgreens. The challenge with Walgreens, the biggest challenge is they're just not, in my eyes, innovating the way some of the other companies are. CVS sees these challenges, and they took a really aggressive approach. They're like, I see challenges, I'm going to go all out and buy Aetna, and we're going to go crazy, buy a health insurance company, do all these changes, and just go for it, take on a huge amount of debt, swing for the stars. And so for me, I think CVS, they went just too aggressive, too much debt, too much for me. Walgreens, though, they're taking a really conservative approach so far. You know what their answer to all of this was? Their answer was, hey, we're going to come in with a cost-cutting measures. We're going to cut costs. I think the management team's coming around like a 1.0 to 1.5 billion a year in cost-cutting measures. So we're going to cut costs. My thought off the bat on that is, look, this problem is bigger than cost cutting. Like cost cutting, any business should always be finding ways to optimize, cut costs, get more efficient with costs. If that is the answer to these challenges, right off the bat, that is something that challenges me. Anyways, moving on, I want to talk about the PE ratio. This is where it gets exciting. So the current earnings per share for 2019, they're expected to come in around $5.07 based on being flat with 2018. If I take the current share price, I divide by 5.07, the PE ratio for Walgreens is a 10.68. So look, they're facing some challenges. They're going to have to, I think they're going to have to figure something out other than cost cutting. But the question becomes, is 10.68 just a bargain basement sale here? It is priced, in my opinion, quite frankly, as if it's going way downhill, way downhill. And so this begs the question, is this a value here? Like, I think none of us are going to disagree that in one way or another, this company is probably going to have to innovate. But at the same time, I think many investors are going to agree that, look, it's priced probably a lot worse than the numbers and the current situation indicate. And that's what I often view as a buying opportunity. It's when the market has overreacted to news. There's been some bad news. In my opinion, it is, yeah, the news is real, it's bad, but this is a overreaction at a PE of 10. And so the payout ratio, 35%. It's the $1.76 dividend divided by 5.07. Dividend, in my opinion, is going to be safe. Will they be increasing it as quickly in the next few years? I don't know, but I like their low payout ratio. So I am not going to spend a lot of time on numbers today, because here's how I look at stocks. I just got to look at the high level first, and then if I'm really interested and I'm thinking about buying it, I'll dig down more. So I got to start today just with the high level. Literally, this is some analysis. It's funny, I woke up last night, still got my cold a little bit, was up in the middle of the night, and was just researching this thing. And so this is kind of my thoughts from just my cursory analysis. But anyways, one of the things I did is I did look at the 2018 annual report. I skipped right to the balance sheet, the income statement, the cash flows, and quite frankly, I'm not going to go through all the numbers, but the numbers that I did see were really good. And I think the only thing that I noticed that I didn't like as much from their report was the accounts payable looked a little bit high. But anyways, I looked through the numbers. I want to highlight just a few. Revenue in 2018 versus 2014 is up 72%. So this company has grown their revenue 72% over 5 years. This is a dividend growth company. This is a company, historically at least, that has grown very well. So it's interesting that they're hitting these headwinds all of a sudden. Net earnings are up 150% in a 5-year period. 150%. And so what I like about this is net earnings are growing. They are growing quicker than the revenue. And so that is really nice. And so I didn't look actually really closely whether that's due to a margin expansion or whether that's due just to share repurchase. And so, because this is on a earnings per share basis that I'm listing here. And so I'll have to look into that more, but needless to say, I like that the net earnings are growing so quickly, the earnings per share. And so long-term debt, it's up 235%, but the reason I want to highlight it here is it's only $12 billion. And so you contrast the debt here, the debt situation with CVS, completely different game. And so this company has positioned themselves really well from a balance sheet perspective. The one thing I would say that accompanies, though, this debt is the accounts payable did seem a little bit high. And so you add up the accounts payable and you add up the long-term debt. This number goes from like 12 billion to probably, I think the accounts payable was somewhere up in the 15 to 17 billion range. And so it gets quite a bit higher. But again, very different situation than CVS, and gives them some room, quite frankly, to buy up some of the Rite Aid stores that are facing troubles right now, which has been a good strategy for them so far. And so I apologize, this is kind of a mess here. I'm going quickly today because, again, don't have a lot of time, but want to get my thoughts out there because this is really top of mind right now, I know, for a lot of dividend investors, and I had a lot of fun looking at this thing. But again, that's what I remember at a high level. There's a lot more, but in general, the numbers looked good, real consistent with the dividend growth situation. But quite frankly, before I need to get into any numbers further, I just got to look at what I like and what I dislike. And this is what I always do with any new stock that I'm looking at. It's a new stock, I don't own it. What do I like? What do I dislike? I want to start with what I like. I like that it's had the historical growth. We've already talked about this, but I personally like dividend stocks that have a lot of growth in them, because the quicker they grow, the more that they can grow my dividend, and my yield on cost can go way up. I like their balance sheet. In general, the debt situation looks good, but I would have to dig into that accounts payable situation a little bit more. I like that they have a cleaner business model than CVS. Look, they're a pharmacy kind of convenience store model. CVS, now they're getting into health insurance. This is kind of confusing. They're taking on all this debt. Walgreens, in my opinion, is cleaner. I like that. They have an amazing PE ratio. I like that. They're priced as if they're going under. Dividend growth is great. Valuation is great. So just from a entry point, like, look, if I believed in the future of Walgreens and I had conviction in the future of Walgreens, I personally think the entry point here is pretty darn attractive from a broader market perspective. I like that their shops are pristine. I have been to Walgreens, I have been to CVS. In general, Walgreens, in my opinion, is a nicer store. Usually it has better curb appeal. Usually it's just a nicer store inside. Also, it's usually in a better location, so I like that about Walgreens. That said, they don't seem to own a lot of these stores, and so we'll get into that in a minute. That's one of the things I dislike. And so, what else do I like? I like the convenience store model. I think at the end of the day, people are going to get sick. They're going to have to go fulfill prescriptions. People are going to get hungry. Maybe they run out of food at home. They just want to walk down the street to the Walgreens, grab TV dinner, whatever, grab a drink. I think that having that convenience aspect of it, it's not going away. Yeah, Amazon can become more convenient and have same-day shipping, but it's never as much convenience as going right now, 24 hours a day. So I like that. What else? I like that they've been buying up some Rite Aid stores. There's an opportunity now. Rite Aid's not doing well. They've been buying up stores. It's been boosting their revenue, bolstering their revenue, so that's nice to see. I like that they have international exposure. When I was traveling abroad in the UK, I had the opportunity to go into Boots. I like Boots, and so this is a cool international company. I like that. Now, what do I dislike about this company? We talked about accounts payable. It's a changing space, and they have a lack of secret sauce. So if I had to say one thing that I dislike the most about this company is this pharmacy sector is changing really quickly. And they don't seem to have a secret sauce. So most of the companies that I invest in, you know them. If you don't, I'll link in the description below. You can download my stock portfolio. Most of the companies that I own, they have some kind of secret sauce. They have something special about them. Let's take 3M, for example, makers of this whiteboard. They have patents on so many different adhesives and different solutions that are used both for consumers and in industry. They have a secret sauce, and their secret sauce are the patents and their inventive attitude and just the breadth of products that they sell. It's going to be very hard for someone to come in and disrupt 3M. Most of the companies I own are like that. In their space, they have a secret sauce, they have a competitive moat. It's going to be very hard to disrupt them. And so retail is a tough space, and I look at this as a retail stock. And in retail, one of the companies that I own is Walmart. And Walmart is a very big company. They're doing some disruptive stuff. They bought a lot of tech startups. They've invested a lot of money in innovation, in building out technology teams, and they're going head-to-head with Amazon. Now, from a retail perspective, if someone's going to emerge and do pretty well, I think Walmart has a very good opportunity. Now, Walgreens, is it going to be easy for them to compete with Amazon, compete with CVS? That I don't know as much, especially because I think the only secret sauce that I see them having are the fact that they have really good locations, pristine, clean stores, better curb appeal. That's the secret sauce that I see. I think maybe they have some brand affinity as well. But if you're in the pharmacy space, maybe you are a pharmacist, you work in the pharmacy space, I'd like to know what you think the secret sauce is here. I'd like to learn more. Please share in the comments below. I'll tell you, I guess one of the other secret sauces is I understand it's hard to get approval to be a pharmacy, and so they have to go through all these types of registrations and certifications and to hire the pharmacists to be able to dispense these drugs. I know it's a big deal, and there's kind of a duopoly right now between CVS and Walgreens, and so maybe that's part of their secret sauce is it's just so hard to set something like this up, but it seems like Amazon is going after it. I know Amazon is not accredited yet to sell prescriptions, to fulfill prescriptions in all of the states, just a handful of them, but over time I imagine they will get there. And so I just like to learn, if you are a pharmacist, what do you think the secret sauce of something like this is? It would be really helpful for me. Personally, I don't see the kind of secret sauce here that I see with something like a 3M or in the retail space with something like a Walmart. And so moving on, by the way, I'll link in the description below. I did a whole video on Walmart. I'll link to that one. What else? They're going to have less pricing pressure, so less pricing capability. And so historically, it seems like Walgreens and CVS have just been doing so well, been growing so quickly, because they have all this pricing pressure, these pricing capabilities to price the drugs, to take huge margin, and that seems to be going away. It seems to be going away. Again, I don't fully understand all the dynamics because I'm not a pharmacist. I don't work in the industry. Quite frankly, I'm not that interested in the industry, but I'm not to offend you if you work in that industry. It's just not my passion. But what I have deciphered so far is there's just facing some troubles there in keeping the prices up high, and certainly that's something that has bolstered their growth and their margins for so long. Seems like it's going away. And so again, share in the comments if you think that's true or not. Amazon, we talked about Amazon, but that is a negative. I think that's a negative though with most companies these days. Hey, Amazon's out there, they have all this money, they don't, not even held to the same standards as other companies. They don't have to make a big profit, and the stock price is huge, market cap is huge, and they'll just go out and disrupt. And so it's interesting. There's that Amazon effect hitting hard here, or at least that's what people think. Also, boy, this upset me a little. I don't think it's big in the scheme of things, but Walgreens said that they're going to follow suit to CVS in the sin stock category, and they may not completely stop what they're doing with the products that these sin stocks manufacture, but they're going to taper it back a little bit. They're going to be more conscious about that. And so that's something that this investor does not like to see. Thug life. Also, it's difficult for me to invest in a company I'm not passionate about. I mentioned I'm not passionate about the pharmacy space because I buy and hold forever. I'm holding my dividend stocks forever. I'm going to live off of the dividends. And so not being passionate about this, it's just hard for it to have a place in my personal stock portfolio as a buy and hold forever investor. And so last, I already have retail. We talked about Walmart. I've got some other retail related stocks as well. And so do I need more exposure to retail? Net, when I look at the pros and cons, this is one of those stocks where it's kind of on the fence. I like the stock. I really like the valuation. I'll tell you the two things that kind of get me the most. It's actually, I like it emotionally because historically it's been touted as a really great dividend stock. And all of the big kind of dividend influencers, I'm talking back in the day, like the Motley Fool type stuff, always touted Walgreens as a good stock. And so coming into it, I'm kind of biased, like, hey, Walgreens is a good stock. But when I look at the numbers, hey, it actually is a good stock. The numbers historically have been really good. And so I'm kind of biased with that going in. And I just like the fact, I'd say second, that it's just priced as if it's going under, it's going out of business. It's tanked so much, and so it's a value, and I like buying a value. Those are the things I like the most. The things I like the least is lack of a strategic plan, in my opinion, disruptions coming, and I already got retail. Quite frankly, I don't really like investing in retail that much, and I don't really see a competitive moat. I look at this as more of a retail type company than a healthcare company, in the sense that my belief is that the pharmacy component is not enough of a competitive moat. And please put in the comments if you disagree or you have more information on the pharmacy business that would be helpful for our community here. Net, I'm not going to be buying this stock in my portfolio. I'm kind of on the fence. I'm going to keep it on the watch list. I'm not going to dig deeper in the numbers, but that's where I'm at. I know a lot of people in the community, they love the stock, they own the stock, and I can totally see that. I could totally see this stock in my personal stock portfolio. It's not there. I already own 40 stocks. I don't see a compelling reason to add this company at this point as a net new position. But look, if someone said you have to buy something in the pharmacy space, night and day I would buy this over CVS. It just aligns more with my personal philosophy. So be curious, what do you think? Do you own Walgreens? What do you think about it? Is a stock that you own, that you like? And what do you think about the pharmacy space? Do you think that these concerns are overblown? Do you think they are in line with what's to come? What do you think about the valuation? Let's have a great discussion. Share in the comments below. This is a thriving community, and I love the fact that we are dividend investors supporting other dividend investors. Hey, before I go today, I want to share one kind of interesting update. One, I continue to sell more stuff on eBay. It's going really well. I'll do a video on that in the future, how I'm selling stuff on eBay, how I'm finding success there. It's generating just a little more money that I'm able to use to invest in stocks. It's really cool, really fun, and decluttering the house. But the other thing I want to bring up, because it's also timely, just like Walgreens, is Bitcoin. If you've been around here a long time, you know that I made a lot of money on Bitcoin back in the day. And I've actually I've mentioned this, I think, at least in my social media or in one of the videos. I have been accumulating not a lot, but a little bit of Bitcoin in the $3,000 range. Well, if you've been following Bitcoin, it's jumped up again. Now it's in like the high 4,000s, low 5,000s. Personally, my stance here on Bitcoin, because it's in the news now, it had this big jump, is the more I learn about it, the more confident I am that this asset is going to be in all of our futures. And the more confident I am that it's going to continue to go up. And so most of my money is in dividend growth stocks, but I have a tiny amount of money that I carve out for other ventures, and one of those is Bitcoin. So just a fun update for all of you that I actually been accumulating a little more. I think as long as it's below 6,000, I'll probably buy a little bit more, but I'm in no rush to have a big position. This is a very small position. At this point, it's just minuscule, very small position in the portfolio, but it could become huge because I foresee a scenario in the future where Bitcoin continues to grow crazy. But anyways, I just want to bring that up because it's in the news just like Walgreens. And so anyways, before I leave today, in terms of a full disclosure, I own two of the stocks mentioned today. I am long. I own 3M, ticker symbol MMM. I own that one in my personal stock portfolio. Also, I own Walmart, ticker symbol WMT. I am long on Walmart. I own that one in my personal stock portfolio. Before I leave today, in terms of a friendly disclaimer, I'm not a licensed investment advisor. Today's video is not investment advice. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Literally just sharing my journey here on YouTube for fun and entertainment. All right, everyone. You can probably tell I churned this one out a little quicker than the other videos, but I wanted to get it to you guys in time. I will see you in the next dividend investing video.